Hi everybody. I get the easiest introduction job because everyone knows Audra. Gaiziunas. I get the hardest name, but I get the easiest introduction because you all know her, listened to her great speech this morning. So I've listened to a couple of presentations that she's done before, and you're going to get something really good, really tangible out of this. So without further ado, Audra.
Thank you, Chris. Good to be back. Looking like a completely different person this afternoon. But I wanted to have a, wait, why does this okay. Alright, okay. Freak me out. Wanted to agree to do a basic explanation because people who are not part of the Star Wars universe or are familiar with the Star Wars universe. I'm not sure what Beskar is. I think it's some type of software, or is I'm trying to sell something. I am not. Beskar is a type of steel that is a metal that is used to create Mandalorian armor within the Star Wars universe. And Beskar steel is the strongest type of steel that they have in making Mandalorian armor. And so similarly, I want to be able to teach you how to use your financials as your Beskar steel. So that steel is made to withstand even light saber strikes. So I want to make sure that what we're going to walk away with today from the knowledge side of things, as well as takeaways, that I'll give you my number, you can text me or email, I'll send it to you, and how to create basically armor for your brewery to protect you from financial distress. So it is a little bit Star Wars themed. I'm nerdy like that. So, but without further ado, we'll walk through that. Most of the you've learned about who I was and my background. This is just my introductory slide that I have. I do live in Asheville, North Carolina. I have an accounting degree. Most of my life I've worked in small business. I made a little veer off by working at Caterpillar as their work tools accounting manager. That was my one and only corporate job I've ever had in my entire life. I learned a tremendous amount. I also hated my life that entire year and a half I was there. And I couldn't wait to come back into small business. Lo and behold, I went from Caterpillar to working for Sam Calagione, which is like the polar opposite of corporate hierarchy and, and everything else that goes along with it. And he's the one who inspired me to start home brewing. And it's been 16 plus years now that I've been in beer, and I absolutely love it. Currently, I head of finance for Burlington Beer, teach through various programs. Unfortunately, University of Vermont is shutting down the assistant craft beer program after this spring semester. So this is my last time teaching brewery finance and accounting. University of New England is going to be starting a program though, so I'm pretty excited about that. Hopefully they'll pull me in once UVM shuts their program down. Also, the Brewers Association Finance Committee Chair as of February. I got elected to the board as an at-large member to replace Peter Skirbeck, who is the CEO of Deschutes. They had a gap in finance on the board and somebody that had a lot of financial knowledge, and lo and behold, I got a tap on the shoulder and got voted in. So I'm very honored to be able to serve and provide a voice for the smallest of our members, because most of who I work with can produce less than 2,000 barrels. If you're a regional brewery producing 5,000 or more barrels, more than likely you have a full-time accountant or a controller, a CFO on staff, and you don't need somebody like me. So I work with a lot of smaller breweries, which of course requires a lot more nimble actions to be taken. A small thing, like what would be considered small for a larger brewery, creates a lot greater of a financial impact for us as smaller breweries, and therefore those types of financial decisions are more important than ever that we'd be able to walk through. So happy to be able to provide a voice for us, and I'm here for us as an industry. So today we're going to walk through what our current industry environment looks like, how did we get here, what ratios, we'll do a little bit of a veer off into financial accounting, what ratios you should be tracking now using your financial statements. Then we'll move over to managerial accounting, and we'll look at cost components per product, what overhead is, and then how do we utilize that managerial accounting piece in approaching new products. Should we canvas or should we not? Do or do not? There's no try. So here's I'll provide a pragmatic workbook model for you to be able to utilize back at your breweries. in making these types of decisions. We'll look at 4 costs that every brewery encounters. We'll walk through break-even, what the break-even looks like for your specific business model. I have a cost structure calculation exercise worked in there. We're not going to do this today. The reason I am bringing this to the session is that I want you to be able to calculate overhead, indirect, variable, fixed, and direct costs for this particular brewery. Those are real numbers, by the way, of theirs. Email me and tell me, here's what I got, did I do this correctly, before you calculate your own respective overhead and your different cost buckets. So I'm giving you kind of a practice run to make sure you're doing it correctly. I'll offer feedback, and then you can take those lessons that you learned and now apply it to breweries. So it's kind of like a dry run for what I'd like for you to do at your respective breweries. So it is not something that I'm going to put you on the spot and have done today. And then what other key performance indicators should we be considering as brewery owners? A little bit on open book management. I talked about EOS. We do practice that at Burlington Beer Company. We practice it at Crooked Stave. I was the CFO of Crooked Stave for 2 years in Denver, and we implemented EOS, and they're still using it. It's been tremendously helpful. So I'll provide some tools and resources that we have utilized for these last 2 breweries. There's several other ones that use it. Odell actually used it a lot at Odell too. She was one of the early adopters of EOS. So starting out with what happened from 2020 to 2023. Besides COVID, we know that. So we were offered all these funding crutches, as I mentioned this morning. And we had idle money, we had PPP money, RRF money, we had our statewide, different state by state, we had these different funding programs, and some were grants, some were loans. But then we took all this money, and it was like, even if we were using budgets beforehand in 2019, it's like people stopped using them. It was like, okay, we got this money, we can throw it at our people, we can throw it at payroll expenses. Awesome, we just have to stay open and try to figure out what our next steps are, and all the focus on strategy went away. So a lot of the breweries that I have worked with, we're operating in 2021 and 2022 without a budget. They may have had a budget before, they may have never had a budget, but lo and behold, COVID basically took a lot of that strategy piece out of it. And we never kind of got back on the rails in the regular process of budgeting again. I was like, well, now this has changed a lot. Well, that's changed. How do I budget for it? I'm just not going to. So I saw a lot of that. Examples also that kind of offshoot from that. Idle money was spent on capital projects without any sort of calculations of the return on investment expectations, nor any goals tied to the expansions. We got this money, cool, we can buy new tanks, we can buy new equipment, or we should open a second location, but there weren't calculations of ROI being done. It wasn't like, well, how do we know that this is the right investment for us? Is this what we're supposed to be doing with this money at this time? It seems like it's right, but there was no kind of framework that was set up behind it. So idle money was spent on capital projects without goals attached. PPP funds were spent on payroll without looking forward 12 to 36 months and creating projections to figure out, well, how much sales are we going to need once those PPP funds run out in order to afford our people at this rate we're paying them now. So we had the PPP money come in, paying our people. We know it's a higher rate than we've ever paid before, but there was no planning done looking forward, saying 12 months, 24 months, 36 months. Well, how much sales, how much gross margin do we have to generate in order for us to afford all these people now and implement a plan in place? So PPP funds ran out, we have higher labor costs, our sales are dropping, or maybe our mix went upside down. Maybe what we're selling the most of is a product that is the most costly for us to produce. So that has been a problem. There were at least 2 raw materials cost increases in 2022. There were 3 in 2023. I have an example for packaging, and I was working at Crooked Stave. In January of 2023, our case carton cost was quoted at 98 cents for this particular variety pack we were working on. By May, it was 227 for the exact same thing. So we have to be able to be nimble and make types of decisions based on the fact that our supplier costs can go up very quickly. It's not like, okay, well, we'll just plod on through it with it. Maybe we shouldn't be doing this. Maybe that's not a good idea for us at the time. So that was part of the problem. On average, taproom sales down, I'm talking countrywide. Some places are fine or ahead of projections, but overall, taproom sales are down about 15% with most of my brewery partners, coast to coast. Connecticut took it pretty hard. They're down 20%. The Asheville area itself, easily 15 to 20% down year over year. There's a town outside of Asheville called Black Mountain. It was down 30 to 40% year over year. Chicago, another area, another market, also down. Florida, on the other hand, shining star, just banging it out of the park. Their taproom sales are now down. They're actually up. And Texas was another area. Texas, Austin, the San Antonio area, and Dallas. Most everybody was up in terms of sales, both distribution and taproom. But those are the rare cases. In most cases, taproom sales are down 15%. And now consumers are seeking out, especially the younger consumers, are seeking out low session beers and imperials. And they want the more health conscious NA, low ABV beer, but want to have full flavor that's attached to it. Or the imperials, based on the successes of juice force that we're seeing with New Belgium. But we're still producing beers that we like to produce or have been doing as always. Now, that's not everybody, obviously. But in short, our portfolio is no longer aligning with our consumer tastes and trends, for whatever reason. And so that has caused consumers to go elsewhere for the products that they're seeking out. And it was like 2023 ended up being like, it's a go time year. I had a brewery in Ohio with a $1.3 million loss I talked about in great detail, how we turned it around this morning. But they came to me because they were like, we don't know what to do. We're selling beer. Our beer is outstanding. It keeps winning beers awards at NGABF and within our state, and our sales are growing. Like, why are we still losing money? How can that be? We don't understand. So that was the project that we took on that I talked about this morning. And then I had a brewery in Michigan that had never been profitable in 7 years. And they decided 2023 was the year that they decide, do they stay in the game or do they sell? What's our brewery worth? What are the decisions that are in front of us for us to be able to make? And that's just 2 examples. I have multiple that are very similar. In 2020, the last 2 years, I've done more valuation engagements than I've ever done before. So they're coming, people ask me, what's my brewery worth? And I go through multiple methodologies and talking through them, and I come up with an equity range. Then they decide, kicking the tires around if they want to sell or not. But I haven't done so many valuations as I have the last 2 years. That's been big. And then major decisions, like, well, we expanded our distribution footprint. We don't know if that's a good idea. Should we contract? Should we focus more on our tap room? Should we take the money that we had in distribution? This is a brewery that I just work with. We have a distro footprint out there. Here's the portfolio of products that we are selling. Do we pull that in and invest more money in our tap room and open a second tap room that's another town away? Because we believe we're going to make more profit that way. Should we shrink the circle to have it more locally focused with higher margin product? So that's a project we're still working through right now, but these are the types of engagements that I'm seeing coming across. It's no longer, here's my startup projections, here are my expansions. It's more of like, all right, what are the next steps? What should we be doing next? So that is why we are not filling one with the force. That kind of line. So from the financial accounting perspective, really the focus should be right now is on liquidity and efficiency. And some key ratios for you to calculate right now with the brewery's financials that you do have, your balance sheet, your income statement, and your statement of cash flows. Current ratio The current ratio is your current assets divided by current liabilities. You want that to be 1 or higher. Current assets are defined as assets, items that you own that are cash or expected to be converted into cash within 12 months. Current liabilities are those debts you're going to be paying over the upcoming 12 months. So a lot of times accounts payable, credit cards, the current portion of your long-term loans, those are considered current liabilities. Anything lower than 1 means you don't have the ability to pay all of your current obligations. And that, from the bank's perspective, is going to be seen as a going concern and a red flag. So calculate what your current ratio is. Working capital, you take the same current assets and current liabilities, but it's current assets less current liabilities. The higher the number, the better. Working capital, a lot of times, if you're going to have a current ratio that's going to be less than 1, your working capital number will be negative. So that's also a red flag, because working capital is our assets, current assets that you can utilize within your day-to-day operations, invest immediately back in the brewery to continue on and work within your operations. If that number is negative, you are basically robbing Peter to pay Paul at this point, and you're short on cash. So we want to see what that working capital number looks like. Related, days working capital, you calculated what your working capital is, divide that by your total revenue, and total revenue being your last 12 months, not just 1 month, last 12 months. I try to annualize everything. And what you could do is, let's say you're calculating your days working capital on a weekly basis instead of a monthly basis. So today is March 22nd. The way that I would approach this is, like, if I'm calculating on March 22nd, I'm going to run my total revenue number, any annualized number for any of these ratios going forward, as March 23rd, 2023 to March 22nd, 2024. So take a rolling 12 based on the date that you are doing the calculation, especially if you're doing it on a weekly basis. This also assumes that your books are being kept up to date. So you're not posting entries a month down or a month afterwards or a quarter afterwards if you're going to be running these numbers on a weekly basis. At the very least, you should be running them on a monthly basis, but make sure those books are up to date, because otherwise it's garbage in, garbage out, and this is not going to be very helpful for you. An ideal number that you would have, so working capital divided by total revenue multiplied by 365, that's going to tell you, like, where you should be, how many days you have to operate based on your current pull-through and your current spend. It should be a range based on a business model, so I can't give you a specific number because everybody's economic model is going to be a little different. In most cases, 60 to 90 is a good area to be in for days, total days. Some, if you're taproom focused, you want to have, like, you can get away with a lower number, because your cash burn cycle is not as long, because you're not working with a distribution network and waiting for your check to come in for you to be able to purchase new materials. And therefore your inventory turns to be higher. But that's an aside. It's a range. Calculate, the first step would be to calculate where you are and see, talk to other peers. What are your days working capital looking like? I'll take one. And any other questions before I say any time, you can always reach out to me as well. Then looking at day sales and inventory, so average inventory divided by cost of goods sold times 365. Again, average inventory and cost of goods sold is going to be annualized. So you want to look at it on an annual basis. If you calculate these numbers monthly, what you're going to have now, it will be April of 2023 to March of 2024. So annualized numbers. Average inventory means now everybody in this room, I'm sure, is taking physical counts on a monthly basis of all their raw materials, their work in process, finished goods, and packaging supplies, right? And then adjusting what's on the floor to what the books are, and truing them up. So you should have an end of month inventory balance. So in theory, you should have 12 months worth of inventory balances. Add them up, divide them by 12. That's average inventory. At the very least, take the oldest number, so your April of 2023 number, And your newest number, your March 2024 number, add those and divide them by 2. That's at the very least. But that's what average inventory is. Cost of goods sold, annual. You pull that off of your financials. In most cases, 60 to 90 is a favorable target for day sales and inventory. You want to go more towards the 60 days, the lower end of the limit, if you're producing a lot of hop forward products. You have a shelf life. We want to maintain the flavor character of your hops. A lot of distributors aren't going to take a product that's been sitting on your shelves and in your inventory for 90 days, past 90 days. They'll even put it in your contracts that they won't take your product if it's 90 days or older. So, you're going to be more closer to 60 days. But those of you who are creating more shelf-stable products that are not as hot forward and don't have as short life, you can get away with about 90 days. And then finally, inventory turnover. So you calculate day sales and inventory. Now you're just flipping the numerator and the denominator. Cost of goods sold divided by average inventory. That's going to give you how many turns you're going through every single year. Now, I don't have a specific number for you to target. But if you're in distribution, based on my brewery partners that I work with, if you have any distribution arm that is material, significant part of your business, so I would say more than 25% of your overall sales are distribution. If you're in the 5.3, above 5, we'll say above 5 is a good place to be. If you're taproom model and sell everything over the bar and sell everything through your retail, you should be shooting for 7 or higher for your inventory turns. I remember Terry Ferndorf had done a talk. She was at Great Western Malts. She had talked about super sacks and silos and how often you need to go through an entire silo or the super sack, go through all of your malt. She said 4 times a year. Every quarter you should be dumping that out into product, not dumping it, but creating beer with it to ensure fresh product. So that was my starting point of 4. 4 was my initial target because of that and her advice. But then I started to look at what was selling, how people were selling it, and what turns numbers made the greatest amount of sense and brought in enough cash flow to continue to invest back in the brewery. And that's where the numbers for distro are it's about 5.3. Higher, great, but you're shooting for that. And then taproom being 7 or higher. That provided the greatest amount of return for those breweries within that specific business model. Again, not every case and not every scenario. I'm just giving you some general guidelines. And then finally, the most important ratio for me at all times, and this is the first thing I look at when I'm reviewing financial statements of any single brewery that I work with, regardless of where they are, is your debt service coverage ratio. The banks are going to look at this too. They base some of their debt covenants around this ratio. And that is calculated as EBITDA, which is earnings before interest, taxes, depreciation, and amortization, divided by your debt service. And your debt service are all the debt payments you're making, the principal portion and the interest, both together, what your total payment is for the upcoming 12 months. EBITDA is also known as net operating income. In most cases, it can be used interchangeably for this calculation for debt service coverage. So when you look at your profit and loss statement, you'll have your revenue, your cost of goods, you have your gross margin, then you have your sales, general, and admin expenses, your expenses that you have from your day-to-day operations. And then you have your net operating income as a result. And then you add your interest, taxes, depreciation, and amortization, nothing that really has to do with your day-to-day operations, and you come up with net income. So you want to look at net operating income. That's the line item that the bank is interested, that's the one that they want to do all the calculation off with. This comes directly from the banks I work with. They want to see a 1.2 debt service coverage ratio or higher. That is what number you need to accomplish and achieve in order for them to view you as financially healthy. So if you want to do a quick checkup on how well you're doing, take a look, get your debt schedule together for your upcoming 12 months from each loan that is sitting on your balance sheet, your long-term liabilities. Look at your short-term liabilities too, what credit cards, if you still have an Amex balance, a Chase, a Visa, MasterCard, you have to pay off as well. Have that, that's part of your debt schedule. all of your long-term loans, 12 months of those payments, create that sum of total of those 12 months of all your debt service payments, and then look at what your net operating income is and see where you currently are before you approach a bank. Let's say you calculate that number to be 1.6, and you're looking for an expansion loan to fund a canning line or some minor enhancements that you want to make to your brewery. If you're at 1.6 now, you can use algebra to figure out, well, how much more can I ask for and get that number to be 1.2 or higher that the bank would potentially approve. So it gives you an idea of how much you can actually afford to take out in additional debt if you are looking to do something like that. So if you're already in a financially healthy position, if you're above 1.2, just make sure that that loan amount that you're potentially asking for isn't going to put you in a position of where you add those 12 months worth of payments for that new loan, and it brings your debt service coverage ratio to below 1.2. But this way you can do this and look at it proactively. Yes, your question.
So, like owner's equity in this account?
No, the entirely debt. Yeah, this is going to be, because it's your debt covenants and everything that's tied to it, owner's equity completely different story. Yeah. So let's say you're trying to figure out how to create a, yes, question.
I'm just trying to get the debt side. So where does rent go on either side of that equation? Is that
No,
an
we don't
expense?
have rent. No, that's occupancy costs.
Okay.
So rent would already have been part of net operating income
Okay.
because you've already subtracted that out of your expenses
Gotcha.
to get you to even that. Yes.
Owners that pull a high wage or a high salary, how far back are banks looking at to achieve that 1.2? Can you take
They
a
want to
look?
look at current. They're not looking at past anymore. They want to see what's going on with you now.
Okay, so if you stop doing that pull, 6 months before,
They may ask you about, like, what are you doing? Are you going to post that? You could potentially post that as a liability, like owner's payment payable. You could put that in there as a current liability.
okay,
Yeah, so that you're still recognizing the expense of the owner wage, but you're not doing the draw on it or paying the guaranteed payment depending on how your tax.
yeah.
Yeah. So looking at budgets, if you're trying to figure out, okay, I haven't budgeted now in years, what am I gonna do? Like where do I start with? Like I haven't done a budget since before COVID. Where should I start? You can start with the debt service coverage ratio. So when you calculate where your debt payments currently are, you can take that sum, multiply that by 1.2, and that'll give you your target EBITDA, your target net operating income you should shoot for the upcoming year when you create your projections. It's a great place to start. If you don't know where, you know how much debt you owe, you know how much you're paying monthly, you know how much is outstanding. Sum that up, multiply that by 1.2, that will give you what your target EBITDA should be, your net operating income for your projections. And then walk backwards from there. I love the debt service coverage ratio. You should all love it too. You can do so much work around your brewery by knowing what this number is. It is so powerful. And then when you approach a bank, you can talk about that, and they'll be like, you know what the debt service coverage ratio is. That is one of the first, if not the first number they always calculate. Guaranteed. So let's shift over into managerial accounting. I get very talkative when I talk about this type of stuff. I want to make sure I stay on track. Okay. So, cost components. Every single product that we're creating is going to have direct materials, direct labor, and overhead. So this is managerial accounting. We'll switch over from financial accounting to managerial. I'm not going to read the slide. You can get this presentation. I sent it to Paul and to Chris. That'll be available, and this is recorded. You don't have to. I'm not going to read this. But it gives you a definition of what overhead is. It's an accounting term. You have to pay it, regardless of whether you produce 0 barrels or 5,000 barrels. There's a certain amount that you have to pay month to month. But you're not just using it for budgeting, but you should be using it to determine how your pricing should be set up and how much profit you're truly making. So, something that I definitely want to have as a takeaway from this slide was understand what your fixed overhead is. If you produce 0 barrels and sold 0 barrels this month, which expenses would you still have to pay? So take a look at your line by line on your income statement, walk through that, and if you produce 0 barrels and sold 0 barrels, which expenses would you still have to pay? The reason I also bring this up is that when we're making pricing decisions on our beers, whether we're selling it through the tap room, through distro, whatever, kegs, we look at the direct materials piece. We know what our bill of materials is, our recipe. I know how much it costs me per barrel to make from the ingredients perspective and packaging. I know how much it's going to cost me in terms of labor, how many hours it takes to brew it, to package it. I can estimate that. But everything else kind of gets pushed off to the side, and we make a pricing decision based on direct materials, direct labor. That's it. Forget that other piece. So many breweries fall into this trap. So we think we're making more than we actually are. So I'm encouraging you to incorporate overhead calculation, know what your overhead is for your brewery, and incorporate that within your pricing and decision-making processes. But the first step is to know what that overhead is for your brewery. There's 35 breweries in the room. You all have different overhead rates. And there may not be one that's an ideal one. I can't give you an exact, I can't say like, you should be not spending more than $5.21 per barrel. It's varied. It's going to be varied from brewery to brewery. But you need to know what that number is so that you can work with it. Know that overhead expenses can be fixed or variable. So some are fixed, they're going to be the same from month to month, which is rent, insurance, your dues and subscriptions, your software subscriptions. Doesn't matter how much production you have. It's going to be the same month to month. And others are going to be variable. The more production, the more spent. So shipping, logistics, mailing, that was an example I put in there. But overhead expenses can also be semi-variable. So there would be a fixed piece. Think about your cell phones, your plans that you have, your bills. You have a fixed piece that you're going to have a line charge regardless of how much data you use. And then you have a variable component. Based on the amount of data, you're going to have a surcharge on top of that. So my rule of thumb when it comes to semi-variable overhead expenses is, what's the material piece? Is it majority fixed with a little piece variable? Then I count it as fixed overhead. If it's a small fixed piece and a huge variable component, I'm going to count it as variable when I'm doing my calculations. I try to keep it as simple as possible. Don't overcomplicate it. You can overcomplicate overhead. You can put it by department. You can have manufacturing overhead, selling overhead, admin overhead. I know Russian River does this, by the way. But that's because they have a very competent controller in place there. You can complicate it, and you can pull the variable pieces out from the fixed. But I'm assuming that we're all starting from square one here and just calculating general overhead for our respective breweries. So I say, what's the material piece? Is it more fixed or is it more variable? Put it in that bucket. It's a good place to start. Again, you don't have to get it perfect the first time. It's the fact that you're going through the process. That's what's more important, and I want to make sure you do. So this is where I was talking about, you can have general overhead, which is what we're doing within this class, but you can have manufacturing, admin, and selling overhead. So those are just examples of costs that are incurred with that type of overhead. Again, I'm not going to read that slide. You can read it later. This is much more fun. So calculating overhead and how it slots in with our bill of materials. I wanted to give an example here. So let's say this brewery has produced 1,500 barrels over the year. That translates into 46,500 gallons. I'm going to look at my annualized income statement, and I'm going to take all those pieces that are not direct materials and not direct labor, add those up and create a pool of them, annualized. So I included depreciation, but I also said I don't use depreciation for pricing decisions because it's not part of net operating income. It is a part of overhead, but I don't use it when I'm making pricing decisions. That's just a personal thing and a best practice. So, because it's not, my operations are not affecting that number. So we have a pool of 108,271.29. That translates to $2.33 of overhead per gallon. So I produced 46,500 gallons. Here's my overhead as a cost pool. Divide that number, 233. And now I'm going to use that 233 for pricing going forward. I'm going to incorporate that within the bill of materials that I'm working with. So here's a bill of materials for an IPA that I've created. So we have all of that, and I'm sorry, it is so small here right now. But that's my recipe that I have. So all of my direct materials are up here. That's my recipe, my bill of materials here. I have all of my brewing labor broken down to an hourly rate, how many hours to brew. Here's all my packaging supplies, which I will utilize when I package the beer. And then cellaring and packaging time, I've incorporated in here. But now you see this overhead line right here that you don't typically see when you're making pricing decisions. That's that $2.33 rate that I have put into the 7-barrel batch. 7 barrels times 31 gallons times 233 is the 506.24. So my all-in cost for making this IPA is now direct materials, direct labor, and overhead based on the overhead rate that I have calculated for the previous year. It's your starting point. Your overhead will change. You can project overhead for the upcoming 12 months and use that rate instead. Baby steps. We'll start with what has been our overhead rate for the last year. That's our all-in cost. So I have direct materials of $1.86, like $130, a little over $130 per barrel. Direct labor is at $55 per barrel, and then overhead rate is at $72.33 per barrel. That gives me the full cost of that particular recipe for the brewery based on my economic model at this time. And now I make pricing decisions off of that. So I know what my full cost is per barrel. If I charge this $9 per pint, if I charge $95 per sixel, what's my revenue per barrel? Now I know what my true revenue is. It gives you a much clearer picture. So 130, okay, so we have that. We have an IPA that we've created. It is taken off. It is a banger. We love it, people love it. They're asking, when are we gonna can it? When can we get this beer in cans? Ready, we'll buy all of it. But we've never canned it before. So now I know what my bill of materials looks like with overhead calculated in. Is this the right decision? Should I can this beer or should I not? So I created this workbook that I work through, and again, text me your email and I'll just send it to you. It has all the New York information in there right now, including your excise tax of 14 cents per gallon, unless that has changed in the last 2 months. 14 cents per gallon. So if I'm going to let's say I want to make this in 16-ounce cans, my target price to the consumer, blue cells, by the way, if you're ever working with me or if you've ever had a model of mine, all blue, everything blue is an input cell. Everything that is not is going to be formulas and formulaically driven. There's going to be some mathing that's behind the scenes. But blue, you have free reign to work with whatever you want. So let's say we wanted to see, well, what should we price it? What if we price it at $15.99? I know that it's going to go through my wholesale channels, so my normal retail margin, the retailer's making 25%, wholesale margin 30%, and I'm going to walk my way backwards through this. So you input what the wholesaler's making, you know what that is, you usually have it in your contract or your agreement. Retailer expectations, most of the time it's 25%. Put that in there, and that's going to give you a target laden cost for your wholesaler. That's going to include your FOB, New York excise, and freight included in there. And then you walk out your excise tax and freight per case from A to B. You can figure out what your freight is on a case equivalent basis by using your inventory management software and whatever information you have financially. This can be done. You know how much you've produced over the last quarter, over the last year. You know what your freight costs are. You figure out what your case equivalent is, just with some math. And then you work in what your minimum gross profit margin is. How much does the brewery have to make? How much margin do we have to make in order for us to be able to afford all our selling, general, and admin expenses? So I'll put in 35%. And then it gives me what my target COGS are going to be per case. All in, with packaging, labor, overhead. You have your payroll, so you can utilize your payroll to figure out what your labor is going to be per case, or per keg if you decide to model this and create kegs out of this. And then I left packaging components because they've been in flux so often, and depending on whether you are using a mobile canner or whether you're canning in-house, those costs are going to look very different. Those mobile canners are gonna upcharge you. Well, sorry, mobile canners are in the room, but you do. And then it changes. It can change from batch to batch based on where they're supplying them from. So I left that as blue so that you could regularly input that and see where that's going to flux and change. And then the piece that people miss often is your yield. What is your production yield going to be? Anything hot forward? I put an 85%, I think that's pretty optimistic. I mean, having 15 to 20% loss is pretty common when we're dealing with a lot of hot forward products. But I'll put an 85% as our yield. And what that gives us is target ingredient cost per barrel brewed. We're going to can this and charge the consumer $15.99 per 4-pack. We should not be spending more than $103.45 per barrel that we brew. Where are we at with that IPA with raw materials per barrel brewed? 120.18. We should be at 103.45. Okay, what does that tell us? Want to bump up price, that's one thing. Put it in $16.99, $17.49, $17.99, until you get to the target ingredient cost of the 120. Or you lower the gross profit margin of the brewery. You decide to take less. Not going to make 35%, I'm going to make 28%. And that way, like, in some cases, especially if you're using a mobile canner, you may realize, I'm going to make 5%, 4% on this beer. Should I do that? I don't know, that's ultimately your decision. For some of you, it may be a branding, a marketing decision. I personally wouldn't do it a lot of times, but at least you know what that number is going to be when you're going and decide to make that move. It's not like you're just like, well, people want it, I'm just going to make it. I know I'm only making 5% on it. I'm going to move forward with it. That's your decision. The third thing you can do, you can can another beer, or you can analyze your recipe of that IPA. Can I draw any more efficiency out of this recipe? Can I change the timing of this hop and this amount? Is there any way I can pull some of that malt off and it doesn't change the quality of the beer that I'm producing? Just a little bit. It's not that much of a difference. 120 to 103, or it be a combination of all three. Tweak the recipe a little bit, maybe bump the price up $1, take a little bit less gross profit margin. Now you have a model to work with. It's a lot of mathing, I know. This is like drinking from a fire hose. Every technical session will always be like drinking from a fire hose. But I promise it is actionable and useful advice. You just have to sit with it a while. I would expect you to pick this up at a minimum of an hour. So 4 types of costs that breweries encounter. This is the important piece. This is the piece that leads to the exercise that I want you to do back at your respective breweries. You have direct costs, indirect costs, fixed costs, and variable costs. Every cost can be defined with 2 of these 4 costs. Every single cost, when you look at your profit and loss statement, go through it line by line, every cost is going to be direct or indirect, and it's going to be fixed or variable. So direct costs can be traced directly to the product, to the batch, your bill of materials, your direct labor, or we just walked through that recipe. Indirect costs can't be directly traced, so they're allocated based on some activity driver. And in my case, I usually use gallons produced or barrels produced. If I'm looking at sales, I may be looking at gallons sold or barrels sold. But typically gallons or barrels produced is my number that I'm working with as my activity driver. And then fixed costs, which are not going to vary with the level of production, such as your lease, your insurance, dues and subscriptions, and then variable costs. That is going to be changing definitely with the level of your production. So your direct materials, the materials that are used in production, your labor hours spent, the more produced, the more expense. The less produced, less expense. So get to know your business models. Go through your profit and loss statement, line by line, and label each line item, fixed or variable, and direct or indirect. First step. The break-even point is that level of sales where your profit is 0. So that formula is sales minus variable costs minus fixed costs equals 0. You can switch things around algebraically and make it look a little different, but at the end of the day, that's what the break-even point is. To determine sales, you're going to multiply your sales per unit by the units sold. Your variable costs will be variable costs per unit by the same amount of units sold. And that sales level that makes the formula equal to 0 is the break-even point. Your fixed costs are going to be a pool. They're not going to be done on a per unit basis. So this is the way I typically write the formula, is that sales of X minus variable cost of X minus fixed cost of 0, where X is the number of units sold. And then once I'm past break even, I try to figure out what my financial goal is for the year so that 0 is replaced with whatever financial goal is. I want to make $150,000 of profit this year. So that 0 is replaced with $150,000. Whatever it may be. That's what your financial goal is. So an example, let's say we're selling our beer for $36 a case. Our rent is $1,000. Utilities are $250. Barley and hops are $3 per case. Packaging, $2 per case. Excise tax is 50 cents a case. Labor is $2. Now, I know those numbers are not realistic. We all know labor is more than $2. This is just for the sake of the exercise. So what the break-even point is that, all right, sales price, $36. I'm going to replace that at S with 36 of X because we're solving for the number of units, minus all of my variable costs per case. So my barley, hops, packaging, excise tax, and labor, add those together, that's $750. Multiply that, that's with the X, minus my fixed cost pool, which is your rent and your utilities, $1,250, equals 0, and then switch things around. Combine, this is Algebra 101, combine your 36X, 750X, come up with 2850 times X equals 1250, and now solve for X. You need to sell 44 cases, 43.86, but nobody's going to sell a partial case unless you're doing all through the tap room. 44 cases is what you need to sell in order to break even. So that's the example. So how do you apply that to your own respective breweries? You've gone through your income statement. You've gone through it line by line. You've labeled each cost, fixed or variable, and direct or indirect. Now go through it. And what I did with this brewery in Ohio that I was working with is I took like a dry easel and a dry erase marker and I created a quadrant, a big plus. And I had a fixed quadrant, a variable quadrant, a direct quadrant, and an indirect quadrant. All right, guys, you calculated your costs. What is it? What's each quadrant look like? Your check and balance that you did that exercise correctly is that you should get a total when you add all four of 2 times your total expenses. Because you labeled each line item with 2 labels, it should be exactly twice what your costs are. That's the check that you've done that correctly. So you have those 4 quadrants. Take that indirect quadrant, divide that by the number of barrels you sold last year, or if you're using this for projection modeling, the number of barrels you project you're going to sell in the current year or the upcoming year. That's your overhead rate per barrel. How to do it the most simple way. Take that indirect by the barrels, divide it by the barrels you project you're going to sell, or the barrels you sold last year. That's your starting point. That's your overhead rate per barrel. Use that rate for your analysis when creating pricing scenarios going forward. Then you take your variable bucket, your variable quadrant, divide that by the number of barrels sold over the past year. That's a VC component within your break-even formula. Keep your fixed bucket as a dollar total, that pool. Keep it, leave it as is. That's your FC, fixed cost component. And then divide your total beer sales dollars by the number of barrels you sold over the past year. That's going to be the S component of your break-even formula. You can also do that. You can break it apart as tap room from distribution. But again, as adding complexity to the model, we'll just start simple. You can drive complexity from that going forward. So divide your total beer sales dollars by number of barrels sold over that. That's your S component for the break-even. Set your financial goal in dollars for the year, and then solve for X. So in this case, X is expressed as barrels. So sales of X minus variable component, which you have, you calculated it yourselves, in that quadrant of X minus fixed cost equals your set financial goal. If you don't know where to start, again, that's where the debt service coverage ratio comes in really handy. I'm gonna use that 1.2 number. If I know what my debt service is, all the debt payments I have to make, my monthly payments, I know what that total is, I'm gonna multiply it by 1.2, boom, that's my financial goal that I need to reach for the year. I have all the other pieces in front of me. I just have to assemble them a little differently. This is using managerial accounting to make decisions. You don't have to follow generally accepted accounting principles when it comes to managerial accounting. It's your own economic models, and this is a lot more friendly for non-financial brewery owners to utilize. It's a method that's very powerful and very helpful. So, use that debt service coverage ratio if you don't know where to start. To know that debt service coverage ratio. So some other key performance indicators to track that I find to be very helpful. Production labor dollars per barrel brewed. Make sure to include your barrel taxes and benefits. Total labor dollars per barrel sold. I like to use that for my sales team as well. I want to help my sales team communicate with my production team. So keeping that metric aligned for both is very important. I look at a trailing 12-month net income or loss always, because if we are running behind projections, I know what my budget or target is for the upcoming 12 months for my net income. How far behind are we? If I'm looking at my trailing 12-month net income or loss based on where we're supposed to be, and I know what my wholesaler gross margin is supposed to be, I can tell my sales director, we need to do $4,300 more of sales weekly now. $5,600. Some cases $30,000 more. But you know what that number is, and it provides more guidance for your sales team, which is really helpful. So, trailing 12-month net income loss, that's what I use, with the incremental weekly sales needed to break even or reach a goal. You can also break apart taproom sales from wholesale sales because your margins are very different. And make sure to use the gross margin for each of the division of business. So, again, these are examples. I'm not giving you any specific numbers because it is illegal for me to give you pricing information. But let's say it's 52% wholesale, 71% taproom. The amount of sales that you have to make weekly is going to look different based on your margins. Different. So putting open book management into practice, I talked about that in this morning's keynote. Most of the time what I do is I meet weekly with the leadership teams of the breweries that I'm working with, and we review all those key performance indicators we talk about today, and we look for issues and assign accountability. Why is this happening? Is this the production side? Is it sales side? If it's outside of us, then who's that touch point for that outside person? We need to reel that in, we need to fix this. I also project 12 months of income statement and cash flow quarterly. So, let's say we're about to finish Q1 of 2024. I'm going to meet with a lot of my breweries in April. I'm going to review Q1 of 2024 versus what we had projected. And then at the end of that meeting, I project Q1 of 2025. So I'm constantly looking at 12 months of rolling data ahead of me, from both the P&L as well as the cash flow perspective. It's going to give me so much more insight. Rather than I'm going to calculate the annual budget once a year, I'm going to review budget versus actual. Okay, the year plods on, but we're not looking 12 months ahead at all times. We just go through the annual budgeting exercise again in October. I always look at 12 months. For me, October is no different than April. I'm always going to be 12 months looking forward. Cash flow being the most important thing. So here's a couple of resources for you to talk about EOS, and putting open book management in practice. They're not the only resources. They're the ones that are just more commonly used. Then online, where instead of creating a dashboard in Excel, I use 90.io. It's like you spell out the word 90.io. And you cannot get paid anything for using the software for mentioning them, by the way. I mention it because it's only $14 a month. And for me to be able to have access to all the different breweries and their key performance indicators that we calculate, regardless of our location, in one centralized spot. It gives you trailing 13 months of information that you have. For me, 14 bucks is a no-brainer. Very easy. And it's very intuitive and easy to utilize. So, but it is based on EOS. So vision, traction, rocks, all that terminology, if you're not familiar with Gino Wickman's book, it's called something different with the Great Game of Business and with JetStack. So you're using scorecard instead of KPIs. Like you just use a different nomenclature. But it's the same concept. I find that to be very helpful as a communication tool brewery-wide. Here's the exercise. I gave you the slide. So label each item as, this is an actual financial statement. Label each item as fixed variable and direct or indirect. Sum up those quadrants. Divide the indirect quadrant by 42 barrels. That's your general overhead per barrel. Get back to me and let me know what you calculate. And then do the same exercise at your own respective breweries. See what you come up with. So despite where we are, in this current business environment, in a dark place we may find ourselves, as Master Yoda said, with a little bit more knowledge, it lights our way, and hopefully I was able to provide that for you today. Thank you for being with me this morning. Thank you for coming back and sticking with me this afternoon. I understand that this material is not the easiest to digest, but I'm here for you and I'm here for us. Thank you again for having me.